Welcome back, everybody. Today, I just wanted to really quickly run through a multiples valuation for a stock. So multiples valuation is a very quick way to get a relative fair value of what a stock might be worth. And how it works is it takes a price metric of a certain stock, let's say price to earnings, price to cash flow, something like that, and it compares it to a group of the stock's peers, basically their average or median of the same metric. And one of the reasons why the multiples valuation is so popular is because it's quick and it's easy to do. So it's used a lot by analysts and just anybody out there trying to figure out what a stock might be worth. So we're going to go through this spreadsheet that I built. Don't worry, it looks way more complicated than it is. There's really only like a couple formulas in there from Google Finance. There's really nothing there. And I'll just show you kind of how it works. So for the first example, we'll do price to earnings. I like to use price to cash flow more often, but price to earnings is much simpler to create in a spreadsheet, so we'll do that one first. All right, so we go into the spreadsheet. You see I have my stock ticker here. I have the name of the company, which is literally just a Google Finance function. The price, which is also Google Finance. And then price to earnings, which is also Google Finance. So pretty simple. I'm just typing in the ticker and it's pulling everything else in. Now, the whole point of the multiples valuation is to provide peers to the stock that will help you get an idea of what fair value means. And usually peers are stocks within the same industry, stocks that have the same business model. And this is where a little bit of judgment comes into play. You have to pick the right peers for it to be a good model. And so there's a couple of ways to do that. You can go to places like Seeking Alpha and just look at the peers tab and literally just use the same companies as they have there, as long as you trust kind of their judgment. And a lot of times you can go to other websites or even your brokerage, and they'll provide peers in their research as well. In my case, I use Schwab, and they also have a list of peers in their research. And once you get your list of peers, you can simply just start typing in their ticker symbols. And they're using the exact same Google Finance functions that we used for Valero. And as you start to enter peers, these numbers down here start calculating. This basically takes the average price to earnings of all the peers that you entered. And all we're doing is a basic average function and only choosing the peers, not your actual stock. Below that, we have the median price to earnings, which is just using a basic median function of the price to earnings values of the peers. Now, the reason why I have the average and the median is that depending on your data set, you can have values that really skew the average to where it's not a real useful number. And having the median there is nice because it can kind of help balance that out a little bit. Now, in my particular spreadsheet, I have it to always choose the lowest of these two numbers, just to be conservative. And then lastly, you can see here I have a margin of safety, and I'll show you how that gets used at the end. Now, once you have an average price to earnings or a median price to earnings, then a fair value per share can be calculated, and that's calculated right here. And all this calculation is basically doing is it's choosing between the average of the median and taking the lowest one. That's what this min function is. And it's dividing that average price to earnings or median price to earnings by the actual price to earnings of the stock that I entered, in this case, Valero. So because the median 4.61 is lower than 5.72, what it's doing is taking 4.61 and dividing it by 4.33. And what that'll give me is the ratio of the median price to earnings to my stock's price to earnings value. And then once I have that ratio, all it's doing is multiplying it by the stock's price, which in this case is 125.6. And so how that works is that if my stock has a lower price to earnings value than the median, then my stock price is going to go up because the ratio is going to be greater than 1. Whereas if my stock has a higher price to earnings, then the ratio is going to be less than 1, and it's going to drive the fair value price lower than the current price. Hopefully that makes sense. So once I have my fair value price per share, the current price is just pulled in with, again, a Google Finance function. And then I just do an extra calculation to tell me how far away from fair value is the current price. And in this case, it's 6%. And now target price is basically where my margin of safety comes into play. If I say the fair value price per share is $133.72, I want to have a margin of safety on my investment, meaning I want to buy at a percentage lower than fair value so that I guarantee a good return. In my case, I always use a margin of safety of 20% as a guide. So when I take that 20% to the fair value price per share, I get $106.98, which is 80% of 133.72. So obviously I added a bunch of stuff that is unnecessary to do this valuation. You don't need all of that. All you really need is to be able to pull in your price and price to earnings, calculate a simple average or median, and then use that to create a fair value. So as you can see, it's pretty simple to do. Now, let me show you real quick my version that I have that is using price to cash flow. It's almost identical. The only difference is that in this column, I'm using price to cash flow instead of price to earnings. And ultimately, I like using price to cash flow more, but as you can see, this works for any price metric that you want to use, even something like price to book value. So all the calculations that I have in here are the exact same. The only difference is the price to cash flow measure. And now there is no Google Finance function to pull in price to cash flow. So either it's something you can add manually by looking it up on places like Seeking Alpha or any other website, or you can try to pull it in from other websites automatically. But the point is, all you have to do is create your price metric in that column and then run your average and run your median and then do your calculation that compares the average or median to your stock's value of that metric. So hopefully that helped to be able to do a basic multiples valuation. But let's talk about what does this mean and what type of risks are kind of inherent in these type of models. So let's talk about risk first. So number one, you have to pick the right peers, right? So there's judgment involved in picking the right peers. And then number two, picking the right metric, right? Is price to earnings right? Is price to cash flow, price to book value? And that's going to be different for probably every person and maybe every stock, right? Ultimately, I like using price to cash flow because I think it tells me something valuable. So I continue to use that measure. Now, you might be interested in different type of stocks or evaluating them differently. And that's just something you'll have to figure out for yourself. I think most people use price to earnings. I do think there's probably people who use price to cash flow like I do, but again, that's going to be like a personal taste thing. And number three, there's a reason why multiples valuations are very popular is that it's very quick and easy to do. So it doesn't necessarily give you a deep dive into the business fundamentals of what it's worth. It's using one price metric and then kind of extrapolating that into some magical value. So I'm not saying it's not valuable. It definitely can be. But if you're trying to recreate the whole fair value of a company based on one price measure, there's going to be a lot of variability in there. And then lastly, and probably most importantly, just because a stock has a fair value related to its peers doesn't mean that it's not overvalued or undervalued. The whole industry, the whole sector could be overvalued or undervalued. And just because, one company's at 20 PE and yours is at 10 doesn't mean that all of them are going to be at 5 in 3 months. So you just have to understand what you're getting with this. You're getting a relative valuation compared to their peers in terms of where they're at right now. Now, it doesn't tell you what's going to happen in the future. It doesn't tell you if they're all overvalued already or all undervalued already. So you just have to understand that it's used to get a real quick valuation, maybe just to do a spot check of, am I in the ballpark of what this stock might be worth? So if you're going to use it, I would definitely recommend using it together with another method that maybe digs a little bit deeper, just so it balances out a little bit. I like using discounted cash flow method and multiples method just to see if I'm in the ballpark or see if one looks way off compared to the other, because that'll tell me to dig a little bit deeper. Now, obviously, if you guys want to go ahead and create your own multiples valuation spreadsheets, you can absolutely do that with what I just showed you right here. But if you want to use the ones that I use in my video, I make them available on Patreon. So if you're interested, go ahead and click the link in the description. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.